Who are we trying to help? Well, I think anyone who has interest in investing and growing their wealth, they need to understand the taxes, the tax implications of that, right?
And I think we hear a lot of things. We see advertisements, right? Short blurbs, and there's short-term tax benefits, and there's long-term tax benefits, and there's short-term and long-term tax consequences, right?
And people just hear tax benefits and maybe their mind just goes to, I'm going to save on my W-2 income or my active income. And they're not really asking the follow-up questions to go deeper on what that means.
And now this dentist can fully depreciate that larger real estate piece because he's grouping it, he's doing cost segregation analysis, right? He's probably not going to pay taxes now. He's a good income earner. He's probably not going to pay taxes for 3 years, right? So it's not the tool, it's how you use the tool. So you can both defer taxes and you can eliminate taxes in real estate. You just need to understand which tool are you using. The IRS allows this loophole because technically that building is all used for his practice, which is his active trade. So in this situation, this is like the one loophole where they do allow you to take the real estate and group it with your practice.
Yeah. So maybe it's a 900K gain. So now that seller can say, well, I'll do a 1031 exchange.
Welcome to the Wealth Strategy Session.
This is where we unpack one key wealth building strategy at a time and show you how to apply it.
We have an amazing show today. Our Wealth Strategy Session topic is the great debate. Do real estate investors really save on taxes? With me today is the Sultan of Smart Money, Dr. Reed Fald. Reed, the big question, who are we trying to help and what problem are we trying to solve today?
Who are we trying to help? Well, I think anyone who has interest in investing and growing their wealth, they need to understand the taxes, the tax implications of that, right? Like how taxes actually influence returns, how taxes actually help you grow your wealth. So if you care about that, then this is for you and this will help you.
I love that. And I think we hear a lot of things. We see advertisements, right? Short blurbs, and there's short-term tax benefits, and there's long-term tax benefits, and there's short-term and long-term tax consequences, right?
Mhm.
And really understanding all of that helps form the total return on something. So
Yes.
you and I are both all about the total return. And so I think this is a key piece to dive into.
Yep.
Good.
Yep.
Okay.
Yep. Do it.
So format today is one of our colleagues who we really respect made a good post. This person traditionally is a stock investor, not so much a real estate investor. And he saw a lot of advertising on real estate tax benefits, and it hit a point for him, right? He wanted to share something, a kind of a pain point. I felt like things were kind of misleading, and so. We thought this was a great post. There were 7 main pieces he put in here. So we're just going to kind of talk about each of those 7 concepts about real estate taxes and what's real, what's not. And we'll just go from there. The first part of this post, and I'll read it. A lot of dentists get into real estate because they're being told accelerated depreciation is a smart tax play. But the way it's pitched feels borderline scammy. You're not wiping out taxes, you're shifting them. All right, Reed, what are your how do you process that statement? What seems true to you? What doesn't seem true? What do you want to say about that statement?
Yeah, I mean, I think there is truth in that too many people, so people that want to pitch real estate, whether they're capital raisers or different operators that are trying to raise money for their deals, I think sometimes they want to stay vague and they'll just say like, you get great tax benefits, right, from investing in this real estate. And people just hear tax benefits and maybe their mind just goes to, I'm going to save on my W-2 income or my active income. And they're not really asking the follow-up questions to go deeper on what that means.
Mhm.
Whether it's the responsibility of the person marketing those tax benefits or the responsibility of the investor asking the follow-up questions to go deeper in understanding. I think that what our colleague here is saying is like he doesn't like that it feels like false advertising. And I
Yep.
think my pushback is just that I think we all need to educate ourselves well enough to understand and kind of pierce what is just at a surface a vague promotion on tax savings. That's
Yeah.
why.
And I'd look at it like guys selling dental equipment. A guy might be trying to sell you a CT machine. He might be trying to sell you a in-house mill, a scanner, right? Like all those things. And yeah, there can be lots of benefits to those items, right? A very successful implant practice or a very successful same-day practice is probably utilizing all three of those pieces of machinery, right? But it's not the piece of machinery that's doing the magic, right? It's the guy behind it. Are you marketing a funnel that utilizes those pieces of machinery, right? Are you creating a package people understand and so they accept your treatment when you present it, right? And then are you performing that treatment in a time efficient and cost efficient manner and making people feel cared for during that appointment, right? So when I read this, I was like, I get where you're coming from here, but it's never the tool, it's the person behind the tool, right? And so, yes, people shouldn't be selling the tool as the solution. I agree with that, but we also shouldn't be pushing back on the tool being the solution. I mean, the tool, there's something wrong with the tool, right? It's how you use the tool, and I think that was the big thing. The second thing that bothered me here on this piece is you're not wiping out taxes, you're just shifting them. So, it depends on the type of tax strategy you're using, right? An opportunity zone wrapping, if I use the opportunity zone structure that the federal government has created, you actually get a stepped up in basis, right? You get a step up in basis on the front end. Right now, with the new big beautiful bill, you're not paying taxes for 10 years, so that's the deferring piece, the shifting, like he's talking about. But then you get a 10% step up in basis, so you're actually wiping out 10%. And then on the back end with the opportunity zone, you're wiping out 100% of the taxes, both any depreciation recapture and capital gain tax. So this statement, I get where he's coming from. This is a smart guy. I have a ton of respect for him. And it's much easier to sit where we're sitting, analyzing a statement he typed on Facebook, right, than it is in his chair. But I do want to give people clarity who really want to understand this stuff. You can do both. You can continue to defer your taxes indefinitely. I know lots of 80-year-olds who deferred it and then step up basis passed on that real estate to their children. So they did eliminate those taxes eventually, right? And then I also know the OZ very well, where you can also eliminate taxes. So it's not Oh, it's only shifting. It's you can both defer taxes and you can eliminate taxes in real estate. You just need to understand which tool are you using and which one's deferring, which one's eliminating, how much they're deferring, how much they're eliminating. You just got to understand it all, and the timing of that.
Yeah, I think it'd be helpful for people if we just, unless you want to keep going, but just a quick overview of, hey, what is depreciation in real estate and how does it apply to things? So I think that would just be a good starting point because a lot of people don't even understand that. I find myself educating people all the time on that concept. So I think keeping it really simple. We know real estate. Everyone hears the term depreciation, right? And then the more common term now is we talk about is bonus depreciation. So every piece of real estate can be depreciated over time. The government says it's losing its value on paper, right? Because it's wearing out. And so the government allows you to basically take the value of the property, the cost basis, and depreciate it down to zero over a time scale. Residential is 27 and a half years. Commercial is 39 years, right? So whatever the cost basis of the building is divided by that many years, and that's straight line depreciation. Bonus depreciation is when you do what's called a cost segregation study on a property. And instead of taking that depreciation over that linear timeline of 27 and a half years, you get to scrunch more of it up into the front end of ownership. So that means you get to realize a greater amount of that tax benefit. So why is that a good thing? Well, essentially your after tax return is going to be better on the front end of the property, and you get to defer more taxes earlier, so you can take dollars potentially that you'd have to pay in taxes and reinvest it. But I'll ask you this, Josh. So you have this bonus depreciation. How do you apply it to your personal tax situation? How does someone actually use it? Why is it beneficial?
Yeah, so you have to understand that the IRS doesn't look at your income in one bucket. It breaks your income into different buckets. Um, I think the probably the easiest way would be to think of it as passive bucket. Okay, things that you're invested in that you're not actively participating in. Active bucket, this would be like your own business or your trade or your W-2. And then the last one is stocks, those types of things are actually treated as like a third bucket. And then
Portfolio income, right?
yeah, let's call it that.
Okay.
And then and then the fourth one actually would be like gains from selling something, like capital gains from
Capital
selling something.
gains.
Those are
Yep.
there's like 7 or 8 buckets, but they start to overlap, it gets more confusing. But I think those are the simplest ones. Passive, like the best thing would be investing in real estate that you're not active on, that someone else is running for you. The next one is active, your income, your W-2, your business or trade portfolio. Those are like stocks, bonds, those types of things. And then the last one is the when you sell stuff, which is typically capital gain
A
income,
realized gain. Yep.
realized gain. Okay,
Yep.
so those are probably the 4 buckets that I would say. And so your question was, how do I utilize depreciation? So your depreciation applies not so much to the portfolio piece, but the other three. And you just got to think about you match your depreciation with your income. Depreciation is like the negative, it pulls down from it, and income is like the positive, it grows the number, right? And
Mhm.
so let's say I'm invested in a building that I'm not running, okay, I have no involvement at all. Typically that would be categorized as passive depreciation, right? So if I'm invested in passive income and passive depreciation, so if I'm invested in things that I'm involved in, my income is going to be passive, and my depreciation from those, whether it's a cost segregation, accelerated bonus depreciation, it's a lot more depreciation. Doesn't matter. It's all paired up together. Okay. And I want people to understand is as we get older and you eventually retire, everything becomes passive. So someday in the future, all of your income will be passive, most
Yeah.
likely. Okay. So that is where you're headed someday.
Mhm.
Okay. Um, the next bucket, the active, like I'll use dental for an example. That's where most people's income comes as they're, in their 30s, 40s, 50s. Most people's income is active, right? And so that's the big tax bill that people are paying is that active piece. And so when most people are looking for depreciation, especially dentists, it's their W-2, they're looking to offset that income. And the only way to offset that income is with another active, is active depreciation. So where does active depreciation come from? If you're a W-2, there's
You don't
none.
have any. No.
If you own a dental business, it's like, you buy a dental business, some of it's attributed to goodwill. Goodwill is basically your reputation in the community, right? People know this dental practice, they come to this dental practice now, they refer other people to the dental practice, right? That that
Mhm.
that that doesn't have the depreciation. The depreciation is like the other piece, the other 25% on average of value, which is like the improvements inside the building, the equipment,
Equipment.
those types of things. Okay, so that is when you buy a practice, oftentimes the first year or two, you don't have a lot of taxes because you're depreciating that equipment within the building. The other piece that is like the loophole that Reed and I mentioned, and a lot of people do. I have a buddy right now who's moving to the Midwest. He's buying an orthodontic practice, and I think right now 80% of that orthodontic practice is going to be goodwill. So he can't write off a ton on the practice, but he's also buying, I think, 3 buildings because it's one of those orthodontists that, has practices about 20 minutes away, right? 3 of them. And he can take a grouping election. So he can tell his accountant to group that building with his practice in that building. Okay. So the
Which
IRS. allows this loophole because technically that building is all used for his practice, which is his active trade. So in this situation, this is like the one loophole where they do allow you to take the real estate and group it with your practice because you're occupying it. And you can only group the parts that you occupy. So if you own a big building, you only occupy a little bit, you can only group that piece. But because he occupies all of it, he'll be able to do it. So I think that's one place that people get confused because there is that nuance, right?
Yeah.
They're like, oh, I can just take depreciation from buildings. No, it's only the one your practice is in, right? But there's lots of tricks with this. So again, these are just tools, right? And so reading our saying is how do you use the tool? Well, I was talking to him. He's like, do you have any advice? I was like, look, this guy's probably going to push back on the goodwill piece, right? Whatever he's giving you fair numbers, so you don't want to like dink with somebody who's giving you fair numbers too much, and so like you can't really shrink the goodwill. He's probably going to say no to that, right? Because you'd win more, he would lose. Okay, but what's going on here is when the bank's going to lend on all of this, they like dentists, yes, low risk, but they also like real estate because it's very predictable for them. Okay. So, what I would say is the bank's probably going to want a larger portion of this big loan to be towards the real estate and less to the practice. So, instead of splitting the pie on goodwill um, within the practice, the bank's going to be more happier if more is on the real estate. And so I'd have a conversation with the owner or the seller broker about, look, the bank, we're not, the total number's fine. We think you're being fair. Um, but the bank's going to want more on the real estate. So let's shift more of the,
Purchase
let's say it's
price.
a $3 million purchase price to the real estate.
Yep.
And now this dentist can fully depreciate that larger real estate piece because he's grouping it. He's doing cost segregation analysis, right? He's probably not going to pay taxes now. He's a good income earner. He's probably not going to pay taxes for 3 years, right?
Mhm.
So it's not the tool, it's how you use the tool. I think that's the biggest piece.
The key there is that once you understand it in depth, as Josh is saying, then you strategize around it. Like because you know how to get bonus depreciation, because you know the loophole of a grouping election, right? Because you know that dentists are high income earners, and if they're buying their real estate, they're going to have greater access to this loophole, right? Now you can play that game of negotiation where you're like, hey, I can't necessarily pay that much for the practice, but why don't I shift that purchase price to the real estate if it makes sense? And then I can offset that tax loss that I was or the lack of tax benefit I was going to get for how goodwill was allocated and shift it back, and now I get more from bonus depreciation from the real estate. Like you just have to know how to use the tool. That's a prime example.
One of the tool, and you got to create win-wins for folks. So the bank's happy, right? So you're gonna get bending lender terms because they're more is on the buildings. They're happy. You're happy because you're not paying taxes for a few years, right? And the seller actually, this actually helps the seller because you can 1031, right, out of buildings. But you can't 1031 out of a dental practice, right? You're pretty much doing an opportunity zone, which is good too, right? But now the more that's allocated to the buildings, this seller can actually 1031 all of that and defer taxes indefinitely, right? On all those real estate pieces if they so choose. Um,
Just pause there. I mean, if, I know most people probably understand what a 1031 exchange is, right? But if you don't, it's when you're going to sell a piece of real estate, and in doing so, you're going to realize a capital gain from selling it, as well as some depreciation recapture, right? So when this is what Sonny was kind of talking about, our colleague was talking about in his post, was just saying that, you have to realize that bonus depreciation, take it back or recapture it later and pay taxes on it, right? That's the next stage of what he was saying in his post is you're shifting
yeah,
it and you have to pay it back later.
it
Well,
might
10,
be 30% that he's paying in taxes on that sale. On that
yeah,
3 million might be 900K. Keep going.
yeah, yeah. So maybe it's a 900K gain. So now that seller can say, well, I'll do a 1031 exchange and I'll roll all my proceeds into the next real estate acquisition. So he can go buy a piece of real estate where he's moving to or whatever, and then potentially defer any depreciation recapture and capital gains. And therefore, there's no taxable event happening, right?
Yep.
Like that's what we're talking about here.
Yep. I
So
think, yeah.
yeah. We're running out of time.
No, we're not. This is just part one.
We'll call it part one. Okay.
These are key concepts, right? These are
Yeah.
key concepts. So I don't want to rush past this. I think we're going to the level of depth that people need to hear.
Yeah.
So,
Part two, we'll do a part two of the great debate. Do real estate investors really save on taxes? So
yeah.
part
Yeah.
one in the books.
Yeah, let's wrap up this last piece though with this deal because this is important. So the seller can 1031 exchange the gain, right? So if they're, let's say the real estate ended up being 2 million out of $3 million deal, okay? And they've already owned this real estate for 20 years, right? So they've depreciated a lot of it. So their taxes, let's say on this 2 million, just the real estate piece, let's say it would be like 30%, for instance, okay? So 30% on this 2 million, you have
We do the
600
math.
grand in taxes, right?
Yep.
And if we take this 2 million and he invests it in other real estate, and he doesn't pay that 600 grand in taxes, right? It just sits there on the books, right? And oh gosh, well, he's got to pay that someday. Not if he passes away and passes the stuff on to his children, right? There are ways to pass this on, very simple ways, that now he's never paying that 600K. So yes, it's the deferral technically, but if this guy is 70 and he's retiring, he's 65 and he's retiring, and I think he is, then it's like, okay, after if he keeps his next properties for 10, 15 years and he passes them on to his children, we just got rid of 600K in taxes, right? And or you can 1031 after that and do it again. I mean, there's lots of options to defer and eliminate taxes here.
Mhm.
This is a good example. Um, and then I want to go with the practice piece. It's the same concept, right? If he's selling his practice, whatever that ends up being as a part of $1 million to 2 million, same thing. He's got the capital gain, the depreciation recapture, right? And it's kind of the same numbers here. And so there's real opportunities for both of these guys to preserve wealth for their families, for themselves, and following the rules. These aren't hacks, right? These are the government created these and supports these for a reason, right? Because they want people to continue to take their money and move it into job creating, value creating endeavors, right? Like put it into buildings that create jobs, that create value for society, put it into a dental practice, right? That's creating jobs for the people who are employed by that dental practice, right? And goods and services. So this is all in alignment with what the federal government wants us to do. I want to be clear on this. These are not like shady hacks. These are purposeful incentives that politicians put in place to encourage people to grow the economy and create real value and better quality of life for its citizens.
Mhm. Yeah. No, well said. Yeah, and I think one more thing I want to say about that to wrap up is just that again, if you understand that concept of how this all plays into this transaction, you can explain it to the seller as well to show them, hey, you would actually have this greater benefit for you. So you're creating a win-win situation all the way around, but you got to be able to articulate it. Otherwise, you won't get to the closing table with the terms that you want. So I just want to highlight that. I mean, that's a key part is you got to understand it well enough so all parties can get on the same page and realize it's a win-win.
Yeah, 100%. That's key. Okay, well that was fun. This was the great debate. Do real estate investors really save on taxes? Part one. Excited to dive into part two. Reed, have a great week. That's a wrap.
Thanks for joining us today. If you want to connect with us directly and keep the conversation going, join our private Facebook group. We'd love to have you in the discussion. If you want to see or listen to any of our other shows, you can find them on our YouTube channel by searching Dental Real Estate Partners. Or if you prefer to listen in podcast format, look for us on your favorite podcast app or streaming platform.
Content from Dental Real Estate Partners is for informational purposes only and should not be considered financial, legal, or investment advice. All investments carry risk. Past performance does not guarantee future results. Always consult a qualified professional. Dental Real Estate Partners is not responsible for outcomes from actions taken based on this content.